Let me tell you about the worst financial decision I ever witnessed. It was not a bad stock pick. It was not a failed trade. It was not a complicated derivative gone wrong. It was watching someone I cared about destroy their retirement through completely avoidable mistakes. It was 2008. The financial crisis was unfolding. Markets were in free fall. Bear Stearns had collapsed. Lehman Brothers was teetering and would soon fail. The news was relentlessly terrifying. Every day brought new headlines about the end of the financial system as we knew it. And a close friend of mine, a man who had spent 40 years building a comfortable retirement nest egg, panicked. He sold everything at the bottom. Stocks, bonds, everything. He went to cash because he could not stand watching his portfolio decline another day. He told me he could not sleep. He told me he felt physically sick watching his life savings evaporate. He told me he just needed it to stop. So he sold on one of the worst days of the crisis at prices that, looking back, seem almost impossibly low. By the time the market recovered, he had locked in losses that cut his retirement savings nearly in half. He spent the next decade watching the market climb back to new highs while his cash sat there earning nothing. His friends who had stayed invested saw their portfolios fully recover within 5 years and then double and triple beyond that. He never recovered. The retirement he had planned, the travel with his wife, the hobbies he wanted to pursue, the financial gifts he wanted to give his grandchildren, the comfortable lifestyle he had earned through decades of hard work and disciplined saving. It all had to be scaled back dramatically. He went from financial security to financial anxiety in one panicked decision. He made one choice in one moment of fear, and it cost him hundreds of thousands of dollars. It changed the entire trajectory of his retirement. It strained his marriage. It affected his health. It limited his options for the rest of his life. I have thought about that conversation many times over the years, because here is what haunts me. He did not have to make that mistake. Nobody does. The mistakes that destroy retirements are not complicated. They are not sophisticated errors that only experts can avoid. They are simple, predictable mistakes that people make over and over again, despite decades of evidence showing exactly what goes wrong. I have spent over 40 years managing money. I have made billions of dollars by understanding markets, understanding risk, understanding human psychology, and I have watched countless people, smart people, successful people, make the same retirement mistakes again and again, mistakes that are entirely preventable if you simply know what to watch for today. I want to share the 5 retirement mistakes I see most often, the 5 errors that consistently destroy wealth and security for people over 60. If you are approaching retirement or already retired, these mistakes represent the biggest threats to your financial future, and avoiding them could be the difference between a retirement of comfort and freedom and a retirement of stress and limitation. Before I get into the specific mistakes, let me tell you why I care so deeply about this topic. Why someone who has spent his career managing billions would focus on the retirement challenges of ordinary people. It goes back to my own family. My parents were not wealthy. They were middle-class people who worked hard, saved what they could, and hoped it would be enough. I watched them navigate retirement with the constant underlying anxiety about whether the money would last. Would they run out? Would they have to depend on their children? Would an unexpected expense derail everything? That anxiety, that fear of running out, it shapes how people live. It prevents them from enjoying the retirement they worked so hard to achieve. It creates stress that affects health and relationships and quality of life. When I became successful, when I accumulated more wealth than my family could have imagined, I realized something important. The principles that allow you to build billions are the same principles that allow you to protect hundreds of thousands. The mistakes that destroy large fortunes are the same mistakes that destroy modest nest eggs. Risk management is risk management, whether you are managing 10 billion or 1 million. So let me share what I have learned. The 5 mistakes that I have seen destroy more retirements than anything else. If you are over 60, if you are approaching or already in retirement, please take these seriously. These are not theoretical concerns. These are the real-world errors that separate successful retirements from failed ones. The first mistake, and this is the one that destroyed my friend in 2008, is panic selling during market downturns. Let me be very direct about this. If you are over 60 and you have money in the stock market, there will be a crash during your retirement. I guarantee it, not might be, will be markets crash. It is what they do. It is built into the nature of markets. Since World War II, we have had a significant market decline approximately every 7 years on average. Some were mild, down 15 or 20%. Some were moderate, down 25 to 35%. Some were severe, down 40 or 50% or more. But they happened regularly, predictably, inevitably. No one knows exactly when the next one will come, but everyone knows it will come. If you are 60 today, you might live another 30 years. Medical advances, healthier lifestyles, better health care are extending lifespans. A 60-year-old today has a reasonable chance of living to 90. In that time, you will likely experience 4 or 5 significant market downturns. At least one of them will probably be severe. At least one of them will happen when you are older and more vulnerable. The question is not whether you will face a market crash in retirement. The question is how you will respond when it happens. Will you keep your composure? Will you stick to your plan? Or will you panic like my friend did? Most people respond badly. They panic, they sell at the bottom, they lock in losses that they never recover from. And they do this for completely understandable reasons that make terrible financial sense. When you are retired, when you are living off your savings, when you do not have a paycheck coming in to rebuild what you lose, watching your portfolio drop by 30 or 40% is absolutely terrifying. Every dollar lost feels like a month of retirement security gone. Every declining statement feels like your future slipping away. The financial media makes it worse. Every channel is running constant coverage of the crisis. Experts are predicting further declines. Charts show your portfolio plunging. The drumbeat of negativity is relentless. It is designed to capture your attention, and it does so by maximizing your fear in that environment. Selling feels like the rational thing to do. It feels like stopping the bleeding. It feels like taking control of an out-of-control situation. But it is almost always the exact wrong move. Let me explain why with some numbers that I hope will stay with you. If you sold stocks at the bottom of the 2008 crisis and went to cash, you locked in losses of approximately 50%. The market then recovered over the next several years, eventually reaching new highs, but you were not invested, you were in cash, earning virtually nothing, watching from the sidelines as your former portfolio value climbed back. By 2013, just 5 years after the bottom, the market had fully recovered. By 2018, it had more than tripled from the lows. By 2024, it had increased more than 6 times from those panic lows. Investors who stayed invested saw their portfolios recover and then grow substantially. They came out of the crisis wealthier than they went in. Investors who panic sold never recovered. They permanently destroyed their wealth. The same pattern has played out in every market crash in history. Those who sell at the bottom lock in permanent losses. Those who stay invested eventually recover and prosper every single time. The Great Crash of 1929, the crash of 1987, the dot-com collapse, the 2008 financial crisis, the COVID crash of 2020. The pattern is always the same. So how do you avoid this mistake? First, you have to internalize right now, before the next crash, that you will not sell during a downturn. Make that commitment today. When you are calm and rational, not in the middle of panic, write it down. Tell your spouse, tell your financial advisor if you have one. Make it as hard as possible to panic sell when the time comes. Second, make sure your portfolio is structured so you can survive a downturn without selling stocks. This means having enough in cash and bonds to cover several years of living expenses. If you need $50,000 a year from your portfolio, having 2 or 3 years of that amount in stable assets means you never have to sell stocks during a crash. You can draw from your safe money and wait for stocks to recover. Third, limit your exposure to financial news during downturns. The media profits from panic. Every headline is designed to make you scared, to make you feel like action is required right now. Turn it off. Stop checking your portfolio daily. The less you watch, the less likely you are to do something stupid. The second mistake I see retirees make constantly is being too conservative with their investments. Now, this might seem to contradict what I just said about surviving market downturns, but hear me out, because this is crucial. When people retire, they often shift their portfolio dramatically toward bonds and cash. They think stocks are too risky. They want stability. They want to protect what they have. This instinct is understandable but often wrong. Here is the problem. If you retire at 65 and live to 90, you have a 25-year investment horizon, 25 years. That is longer than most people's working careers. And over 25 years, the biggest risk is not market volatility. The biggest risk is inflation. Inflation is the silent killer of retirement security. At just 3% annual inflation, which is below the historical average, prices double every 24 years. That means if you need $50,000 a year to live comfortably today, you will need $100,000 a year in 24 years to maintain the same lifestyle. If your portfolio is all in bonds earning 4%, while inflation runs at 3%, your real return is only 1%. You are barely keeping pace with inflation, let alone growing your wealth. And if inflation runs higher, as I believe it will in the coming years, you could actually be losing purchasing power even as your account balance stays flat or grows slightly. Stocks over long periods have dramatically outperformed inflation. Despite all the crashes, despite all the volatility, despite all the terrifying headlines, stocks have delivered real returns of approximately 7% annually over the past century. That is 7% above inflation. That is wealth building, not just wealth preservation. I am not saying retirees should be 100% in stocks. That would be foolish given the need for stability and the sequence of returns risk I discussed earlier. But I am saying that having no stocks or very little stock exposure is also a mistake for most retirees. Having 40 to 60% of their portfolio in quality stocks is appropriate. It provides enough stability to weather downturns while providing enough growth to combat inflation over a multi-decade retirement. The key is balance, enough safe assets to weather storms without panic selling, enough growth assets to maintain purchasing power over decades. Finding that balance is one of the most important financial decisions a retiree can make. The third mistake is withdrawing too much too soon. There is a concept in retirement planning called the sequence of returns risk. It is technical sounding, but the idea is simple and critical to understand. Here is how it works. Imagine two retirees who both average 7% returns over a 30-year retirement. Same average return, but one retiree has bad returns in the early years and good returns later. The other has good returns early and bad returns later. You might think they would end up in the same place since the average is the same, but they do not. Not even close. The retiree who had bad returns early, while simultaneously withdrawing money for living expenses, depletes their portfolio much faster. They are selling shares at low prices to fund their lifestyle. When the good returns finally come later, they have fewer shares to benefit from those returns. The retiree who had good returns early builds up their portfolio while withdrawing. When the bad returns come later, they have a larger cushion to absorb the decline. This is why the early years of retirement are so critical. If you retire into a bad market and withdraw aggressively, you can permanently impair your portfolio. Conversely, if you retire into a good market and build a cushion, you have much more flexibility later. What does this mean practically? It means being conservative with withdrawals, especially in the early years of retirement, especially if markets are struggling. The traditional rule of thumb is the 4% rule. Withdraw 4% of your portfolio in the first year of retirement, then adjust that amount for inflation each subsequent year. This rule was designed to give you a high probability of not running out of money over a 30-year retirement. But I think 4% is too aggressive in the current environment, with lower expected returns from bonds and elevated stock valuations. A 3 to 3.5% initial withdrawal rate is more prudent. Yes, this means living on less or working slightly longer to build a bigger nest egg, but it dramatically reduces the risk of running out of money. The other implication is flexibility. If you retire and the market immediately drops 20 or 30%, you need to reduce your withdrawals, cut back on discretionary spending, delay major purchases. Give your portfolio time to recover without draining it further. This flexibility can make the difference between a successful retirement and one that fails. Too many retirees set a withdrawal rate and stick to it regardless of market conditions. They feel entitled to a certain lifestyle because they worked hard and saved diligently. I understand that feeling. But the market does not care about what you feel entitled to. It does not care about your plans. If you do not adjust to reality, reality will adjust you in much more painful ways later. The fourth mistake is ignoring healthcare costs. This is the expense that catches more retirees off guard than any other. People plan carefully for housing costs. They budget for food costs. They think about travel costs and entertainment costs. They often dramatically underestimate healthcare costs, and this underestimation can derail even the most carefully constructed retirement plan. Here is the reality that most people do not want to face. Healthcare inflation has consistently run higher than general inflation for decades. While general inflation has averaged around 3%, healthcare costs have inflated at roughly 6 to 8% annually. Medical costs have roughly doubled every 10 to 12 years. A medical procedure that cost $10,000 in 2005 cost $20,000 in 2015 and might cost $40,000 or more today. The average retired couple in America will spend over $300,000 on health care during retirement. $300,000. That is not a typo, and that is after Medicare. That includes premiums for Medicare Part B and Part D, for Medigap supplemental insurance for dental and vision, which Medicare does not cover, for copays and deductibles for prescription drugs, especially expensive specialty medications, and for all the things Medicare simply does not pay for. And that is the average. If you have chronic health conditions like diabetes or heart disease or cancer, if you need regular medications, if you face serious illness, the costs can be dramatically higher. A single cancer treatment can cost hundreds of thousands of dollars. Long-term care alone can cost over $100,000 per year. A few years in a nursing home can wipe out a lifetime of savings faster than any market crash. Yet most people do not plan for this. They assume Medicare will cover everything. It does not. Medicare has significant gaps, significant deductibles, significant copays. It does not cover long-term care at all. It does not cover most dental care. It does not cover hearing aids or most vision care. They assume they will be healthy. Many are not. The reality is that health care needs typically increase dramatically after age 75. The likelihood of needing assistance with daily activities rises sharply with age. The assumption that you will remain healthy throughout retirement is hope, not planning. They assume costs will be manageable. Often they are not. A single health crisis can consume years of retirement savings in months. A stroke, a heart attack, a cancer diagnosis, any of these can transform your financial situation overnight. What should you do first? Understand that health care is likely to be one of your biggest expenses in retirement, possibly the biggest. Build it into your planning explicitly. Do not just assume it will work out. Run the numbers. Include healthcare inflation in your projections. Be realistic, even pessimistic, about what health costs might be. Second, consider long-term care insurance while you are still healthy enough to qualify and young enough that premiums are affordable. Once you have health conditions, you may not qualify at all. The premiums are not cheap, but they are much cheaper than paying for long-term care out of pocket. A policy that covers 3 to 5 years of nursing home care can protect your entire retirement savings from being wiped out by a health crisis. Third, take care of your health. This sounds obvious, but it is the most important thing you can do to control healthcare costs. Every chronic condition you can prevent or manage through diet, exercise, and lifestyle choices is money saved. Every year you can delay needing intensive medical care is a year your savings can continue to grow. Your health is your most valuable retirement asset. Fourth, understand Medicare thoroughly. Know what it covers and what it does not. Know the difference between Part A, which covers hospital stays, Part B, which covers doctor visits and outpatient care, Part D, which covers prescription drugs, and Medigap policies, which fill in the gaps. Know when to enroll to avoid lifetime penalties. The Medicare system is complex, and mistakes can be costly. Take the time to understand it, or work with someone who does. The fifth and final mistake is failing to plan for longevity. People consistently underestimate how long they will live. When asked to estimate their own lifespan, most people guess they will live to around 80. They base this on vague impressions of how long their parents lived, or on statistics they half remember from decades ago. But these estimates are dangerously wrong. Here is the reality: if you make it to 65 in reasonable health, there is a good chance you will live into your late 80s or 90s. Life expectancy at birth and life expectancy at 65 are very different numbers. The people who died young have already been removed from the statistics. If you have reached 65, you have already beaten the averages. Medical advances are extending lifespans every year. New treatments for cancer, heart disease, and other major killers are improving survival rates. Better management of chronic conditions allows people to live longer with diseases that would have killed them decades ago. Gene therapies and other cutting-edge treatments promise further extensions. The centenarian population, people over 100 years old, is one of the fastest growing demographics in the developed world. What was once extraordinarily rare is becoming increasingly common. Planning for the possibility of living to 100 is not unreasonable for a healthy 60-year-old today. This is wonderful news in terms of having more time with family, pursuing passions, experiencing life. But it creates a serious financial challenge that most people are not prepared for. Your money has to last longer than you probably think. If you retire at 65 expecting to live to 85, you plan for 20 years of retirement. You structure your withdrawals and your portfolio accordingly. But what if you live to 95? That is 30 years, 50% longer than you planned. Will your money last? What if you live to 100? That is 35 years, nearly double what you originally planned. Too many people run out of money in their 80s because they planned for average life expectancy rather than the possibility of a long life. They spent freely in their 60s and 70s when they felt healthy and active. They traveled extensively. They helped their kids buy houses and their grandkids pay for college. They upgraded their lifestyle to enjoy the retirement they had earned. All understandable, all reasonable in moderation, all potentially devastating if it depletes the portfolio that has to last decades longer than expected. Then they reach their 80s with a depleted portfolio and decades of life potentially still ahead. The money they spent in their 60s is not available in their 80s. The cushion they failed to maintain is gone, and their options are extremely limited. The consequences are severe. Running out of money at 85 is much worse than running out at 65. At 65, you can go back to work. Even part-time, you can earn more. You can rebuild your health, likely allows it. Your skills are still relevant. At 85, you likely cannot. You may have health limitations. Your skills may be outdated. The job market is not interested in hiring you. You are dependent on Social Security, on family, on whatever safety net exists. Your options are extremely limited. How do you plan for longevity? First, assume you will live longer than average. Plan for 95, not 85. Yes, you might not make it that long, but if you do not and your money is still there, you leave a legacy to your heirs. That is a good problem to have. If you do make it and your money ran out, You face a crisis with no good solutions. Plan for the scenario where you need the money, not the scenario where you do not. Second, consider delaying Social Security. Every year you delay claiming Social Security between age 62 and 70, your benefit increases by approximately 8%. If you can wait until 70 instead of claiming at 62, your monthly benefit will be roughly 70% higher. For a married couple, this can mean hundreds of thousands of dollars in additional lifetime benefits if you live into your 90s. Social Security is inflation adjusted and guaranteed for life. There is no other investment that offers those features. Maximizing it makes sense for most people. Third, consider an annuity for a portion of your portfolio. I know annuities have a bad reputation, and many of them deserve it. Expensive, complicated, loaded with fees and surrender charges. But a simple immediate annuity or a deferred income annuity can provide guaranteed income that you cannot outlive. Having a floor of guaranteed income from Social Security and perhaps an annuity allows you to invest the rest of your portfolio more aggressively and reduces the fear of running out. Fourth, maintain flexibility in your lifestyle. Be prepared to adjust your spending if you live longer than expected and your portfolio needs to stretch further. Build a lifestyle that can be scaled back if necessary. Do not lock yourself into fixed expenses that you cannot reduce. The ability to adapt is one of the most valuable things you can have in retirement. Now let me bring all of this together, because these 5 mistakes are not independent. They interact and compound each other. If you panic sell during a downturn, you lock in losses that make all your other challenges worse. Your portfolio is smaller, so healthcare costs consume a larger percentage. Your withdrawal rate is effectively higher because you have less to withdraw from. Longevity becomes an even greater risk because you have less to last. If you are too conservative and your portfolio does not keep up with inflation, your purchasing power erodes. Healthcare costs feel more burdensome as they inflate faster than your portfolio grows. You may be forced to withdraw a higher percentage just to maintain your lifestyle, accelerating portfolio depletion. If you withdraw too much too soon, you reduce your ability to survive future downturns. A portfolio that might have recovered from a crash cannot recover if you have drained it through excessive withdrawals. You become more vulnerable to every other risk. If healthcare costs blindside you, they force higher withdrawals that deplete your portfolio. You may have to sell stocks at bad times to pay medical bills. Your ability to survive to 95 with money intact is compromised. And if you run out of money because you did not plan for longevity, all the other mistakes become irrelevant. You are simply out of options. This is why retirement planning has to be holistic. You cannot just focus on investment returns. You have to think about withdrawal strategies, healthcare planning, longevity risk, and behavioral discipline all together. They are all connected. A failure in one area creates failures in others. So what should you do with this information? How do you translate these warnings into action? First, take an honest look at your current situation. Are you making any of these mistakes right now? Is your portfolio too conservative? Are you withdrawing too much? Do you have a plan for healthcare costs? Have you seriously considered how long you might live and whether your money will last? Second, create or update your retirement plan, not a vague idea of what you hope will happen. A real plan with numbers. How much do you have? How much do you need annually? What is your withdrawal rate? How will you handle a major market decline? What is your healthcare plan? Run the numbers for different scenarios, including bad ones. Third, build the systems that prevent panic. Decide now, in calm times, how you will handle market downturns. Structure your portfolio with a cash cushion so you never have to sell stocks in a panic. Create rules for yourself about reducing exposure to financial news during volatile periods. Fourth, get help if you need it. There is no shame in working with a financial advisor, especially for something as important and complex as retirement planning. A good advisor can help you avoid these mistakes, can provide an outside perspective during emotional times, and can help you navigate the complexities of Medicare and Social Security and tax planning. Fifth, stay flexible and humble. No plan survives contact with reality perfectly. The economy will do things you did not expect. Your health may change in ways you did not anticipate. Your family circumstances may evolve. The retirees who thrive are the ones who can adapt, who can adjust their plans when circumstances change, who are not rigidly committed to a lifestyle they can no longer afford. I have spent over 4 decades managing money. I have seen bull markets and bear markets, booms and busts, fortunes made and fortunes lost. I have watched brilliant people make foolish mistakes and ordinary people make wise decisions. And in all that time, the most important lesson I have learned is that protecting wealth is just as important as building wealth, maybe more important. When you are young, you can recover from mistakes. You have time on your side, you have earning power, you can start over if you have to. A bad investment at 30 is a learning experience. You have decades to recover. When you are retired, when you are over 60, you do not have those luxuries. A major mistake at 65 can shadow you for the rest of your life. The money you lose is not coming back. The time you lose cannot be recovered. You cannot go back to work for another 30 years to rebuild. The stakes are simply higher. That is why I care so deeply about these 5 mistakes. That is why I want everyone approaching or in retirement to understand them, not to scare you, but to empower you. Because these mistakes are avoidable, every single one of them, with knowledge, with planning, with discipline, you can navigate retirement successfully. You can protect what you have built. You can enjoy the security you have earned. You worked hard to build what you have. You sacrificed, you saved, you deferred gratification for decades. That effort deserves to be protected. That nest egg deserves to support a retirement of security and dignity and freedom. Do not let panic or poor planning or ignorance take it away. Avoid these 5 mistakes. Build a real plan. Execute it with discipline. And give yourself the retirement you earned. That is my message to everyone over 60. That is what I would tell my own parents if they were alive today. That is what I tell my own family. The risks are real, but they are manageable. The mistakes are common, but they are avoidable. Your retirement security is in your hands. Handle it wisely.